Hello friends. Most Americans have a drawer somewhere at home stuffed with old paperwork. Loan statements, utility bills, receipts, contracts, and at some point the urge hits to just throw it all out. For most of it, that is fine, but there are specific documents where throwing them away can trigger an IRS audit, hand a debt collector a legal argument they should never have had, or cost you tens of thousands of dollars in unnecessary taxes. Today, I am covering 7 categories of documents you should never throw away in the United States, what each one protects you from, and exactly how long to keep it. If you are not yet subscribed to this channel, do that now and turn on the bell. US tax law, debt collection rules, and consumer rights change constantly. When they do, I cover it here in plain English before the deadlines pass. Subscribe, turn on the bell, and let us get into it. Number 1. Written proof that a loan has been paid off in full. When you finish paying off a loan, most people stop receiving statements and assume the matter is closed. But banks sell debt. It is routine and it happens constantly. When a lender sells a portfolio of loans to a debt collection agency, the records that transfer are not always complete or accurate. There are documented cases where consumers have been contacted by collectors demanding payment on debts already paid years earlier, simply because the original lender's records were incomplete when the debt changed hands. Without a written payoff letter showing a zero balance, you are in a very difficult position. The Fair Debt Collection Practices Act gives you the right to dispute a debt in writing within 30 days of first contact, but disputing is far easier when you have documentation proving it was already cleared. When you pay off any loan, contact the lender and request a written payoff letter on official letterhead confirming the balance is zero. Keep that letter permanently. This applies to student loans, auto loans, personal loans, and resolved credit card balances. Number 2. The original purchase documents for any property you own. This is the document most homeowners throw away long before they need it, and losing it can cost them significantly at the point of sale. When you sell a primary residence, the IRS allows you to exclude up to $250,000 of profit from capital gains tax if you are single, or $500,000 married filing jointly, provided you owned and lived in the home for at least 2 of the previous 5 years. The exclusion applies to your profit, calculated as sale price minus your adjusted cost basis. Your adjusted cost basis is your original purchase price, plus closing costs paid at purchase, plus capital improvements made during ownership. If you cannot document these costs because you threw away the original closing disclosure and improvement receipts, the IRS assigns you a lower cost basis and a higher taxable gain. On a home sold for $400,000, where you cannot document $50,000 in improvements and closing costs, the difference in tax liability is real and avoidable. Keep the original closing disclosure, settlement statements, receipts, and contractor invoices for all improvements and sale closing documents. Per IRS Publication 523, keep these for at least 3 years after the return for the year of sale. But most advisors recommend keeping property records permanently given the amounts involved. Number 3. All federal tax returns and supporting documents. The IRS has 3 years from the date you file to initiate an audit. That window extends to 6 years if the IRS believes you underreported income by 25% or more. If you never filed a return or fraud is involved, there is no time limit at all. The practical recommendation is to keep all supporting documents, W-2 forms, 1099s, receipts for deductions, charitable contribution records, mortgage interest statements, for at least 7 years. This covers almost every audit scenario short of fraud. Keep your actual filed tax returns permanently. Lenders request them for mortgages, they serve as proof you filed, and they provide an irreplaceable financial record. For IRA and 401k accounts, keep all contribution records, rollover documentation, and Form 5498 statements permanently. Errors in retirement account record keeping can result in being taxed twice on the same money, and the only way to prevent that is documentation proving what was contributed and when. Number 4. Vehicle title and service history. The title is a legal ownership document, Without it, you cannot sell the car, transfer it to a family member, or resolve an insurance claim. Replacing a lost title means filing with your state DMV and proving ownership, a process that costs time and money. Never keep the title in the vehicle itself. Beyond the title, a complete service history has direct financial value. A vehicle with documented maintenance consistently sells for more than an identical vehicle without records, often $1,000 to $2,000 more for a mid-range car and higher for trucks and SUVs. Buyers and dealers use service history as evidence of how the vehicle was cared for. Without it, they assume the worst and price accordingly. Keep all service records and repair invoices for the life of the vehicle. Number 5. Medical bills and insurance. Explanation of benefit statements. Medical debt is the leading cause of personal bankruptcy in the United States. Billing errors in American healthcare are common, and they almost always run in the direction of overcharging. Your insurer sends you an explanation of benefits for every claim processed. This document shows what was billed, what your insurer paid, and what you owe. Without it, you have no way to verify whether what you were charged matches what your insurer actually approved. Beyond billing verification, out-of-pocket medical expense receipts serve a tax purpose. If your medical expenses exceed 7.5% of your adjusted gross income in a given year, you may be able to deduct them on your federal return. For someone with an adjusted gross income of $60,000, that means costs above $4,500 are potentially deductible. Without receipts, you cannot claim the deduction. Keep all EOBs until every related claim is resolved. Keep out-of-pocket expense receipts for at least 3 years after the tax return in which you claimed or could have claimed the deduction. Number 6. Home improvement receipts and contractor invoices. This connects directly to the property documents in point 2, but it is important enough to address separately because it is the most commonly overlooked category among homeowners. Every capital improvement you make to your home, a new roof, an addition, a kitchen renovation, a new HVAC system, new windows, a finished basement, increases your adjusted cost basis in the property. A higher basis means a lower taxable gain when you sell. The IRS is clear. Improvements that add to the value of your home or extend its useful life increase your basis. Routine repairs and maintenance do not. One tax advisor quoted in a national real estate publication noted that buyers rarely keep their original closing disclosure, so when they sell 10 years later, they can understate their basis and overstate their taxable gain by $8,000 to $20,000 in typical transactions. Keep every receipt, contractor invoice, building permit, and inspection certificate for any improvement made to your home, from the day you buy it until at least 3 years after you sell it, and file the relevant return. Number 7. Social Security earnings records, W-2 forms, and retirement account documents. The Social Security Administration calculates your future retirement benefit based on your 35 highest earning years. That calculation depends on earnings records that employers submitted on your behalf. Errors do happen: a wrong number, an incorrectly entered year, a period of self-employment that was not properly recorded. Each error that goes uncorrected reduces your monthly benefit permanently. The tool to catch these errors is your Social Security statement at ssa.gov, which shows your reported earnings year by year going back to your first job. If you spot a discrepancy, you can file a correction. But corrections become harder to prove as time passes and old employment records become harder to locate. Keep W-2 forms for every year you worked. Keep 1099 forms permanently if you are or have been self-employed. Keep pension plan documents, 401k statements, and beneficiary designation forms permanently. Beneficiary designations on retirement accounts override your will. The person named receives the money regardless of what your will says. If you have changed jobs, divorced, remarried, or had children since you last updated those designations, those forms matter enormously. Here is the summary. Written payoff letters for any loan. Keep permanently. Original property purchase documents and improvement receipts. Keep for the life of ownership and at least 3 years after sale. Tax returns and supporting documents.
returns permanently, supporting records at least 7 years.
Vehicle title and service records. Keep for the life of the vehicle. Medical EOBs and expense receipts. Keep until claims are resolved and at least 3 years for potential deductions. Home improvement receipts. Keep from purchase through at least 3 years after sale. Social Security records, W-2s, and retirement account documents. Keep permanently. Scan everything important as soon as you receive it and back it up digitally. Paper fades and gets lost. A digital copy will not replace an original in every context, but it gives you a record to work from when it matters most. Subscribe to this channel and share this video with someone who needs to hear it. See you next time.